don't skip the intro. I know people like skipping intros. I'm like guilty of it myself, but I have some really important stuff that I need to say in the intro, so please don't skip it. Dividends in the UK is a bit of a minefield, and I get asked loads of questions, and when I did the video with Ben on REITs, there were a lot of questions about REIT income and stuff like that, because I mentioned that REIT dividends are classed differently from normal dividends. So I wanted to make this video to show you the kinds of issues that you might have with dividends. However, the most important thing for me to say is that I am not a tax advisor, okay? So if you have any questions, please do contact either HMRC or an actual tax advisor, okay? These are just guidelines, these are things to make you aware of the kinds of issues that you might have, the kinds of things that you need to think about when it comes to your investments, and in particular, dividends from your investments. I don't think I've ever done as much research for a video ever as I did for this one, okay? I spoke to so many different companies. I spoke to REIT companies, I spoke to about 3 different people in HMRC, I spoke to tax advisors, and I still haven't found out everything I wanted to find out for this video, which should just give you a bit of an indication of just how complex tax actually is, and just reiterate the point of this is just a guideline to make you aware of the complications, and you need to talk to a tax advisor or HMRC for your own tax affairs. So what we're going to look at in the video, firstly, is just generally things about the tax allowance and what the tax rates are on your dividends. Secondly, how to pay your tax on your dividends, because there are different ways, depending on how many dividends you get, it depends on whether you do a self-assessment or not. Then we're going to look at REITs, which is the hot topic that sort of sparked this whole video. And then lastly, we're going to look at dividends from other countries. So this is actually something that I wasn't aware of, that I actually had to pay a bit more attention to whether I'm investing in like companies from other countries or just from the UK. If you're from the UK and you want a bit of a guide on how to calculate your dividend tax, my friend has made a pretty cool spreadsheet, so I'm just going to link that down below in her Etsy. You've also got a link to my Etsy, which has my budgeting spreadsheet if you haven't seen that, but her dividend spreadsheet will be down below as well. And the last point I want to make in the intro is that this is specific to UK residents, okay? So I know that the majority of my viewers are from the United Kingdom, so that should be fine. However, if you are based in the US or any other country, of course, this doesn't apply to you. So if you want to still support my channel and watch till the end, that's great. But if not, feel free to sort of click off this video because it won't apply to you. Although you would have seen in the title that it applies to UK dividends. So anyhow, okay, so first things first, the dividend allowance. I've sort of seen circling around a figure of £5,000 for the dividend allowance. This is not correct, okay? The dividend allowance used to be £5,000, but it's now actually £2,000. So a few years ago, the dividend allowance in the UK decreased. We now have an allowance of £2,000 a year. This is a tax year, 6th of April to 5th of April. If your dividends exceed £2,000 in a tax year, you're going to have to pay tax. It's worth pointing out that any dividends you get within an ISA are not subject to tax, okay? So if the only way that you invest is through an ISA, then pretty much you don't need to worry about any of this stuff because it's all safe. You don't have to declare anything, you don't have to do anything with it. But if you have an ISA and then some other investments, or if you don't have an ISA, then you need to pay a bit more attention. So the amount you get taxed over your dividend allowance will completely depend on your normal rate of tax. So basically, if you are the basic rate taxpayer, i.e. you pay 20% of your income in tax, you will pay 7.5% tax on your dividends over the dividend allowance. If you are a higher rate taxpayer and you fall into the 40% tax bracket, you will pay 32.5% tax on your dividends. And finally, if you're an additional rate taxpayer, you will pay 38.1% on your dividends. So in terms of how to pay your tax on dividends, if you receive up to £10,000 of dividend income, all you need to do is just contact HMRC through the phone and ask them to change your tax code. All that means is that in the following tax year, you will have that tax automatically taken off of your main job. However, if you receive over £10,000 in dividends, you will need to register for self-assessment and fill in a self-assessment tax form. Now, you can do this all online through HMRC, you can ring them to ask for help, anything like that, but it's only if you are either already self-employed or get over £10,000 in dividend that you need to fill in the self-assessment. Like I said, otherwise you just need to ring them and ask for a change in your code. Okay, so the fun part, REIT dividends. So most dividends paid by REIT companies are what's called PID dividends. I think that stands for property income distribution. I'm going to double check that before I post this video. But any dividends that are paid as PID dividends are actually paid from tax-exempt profits, which means that the REIT hasn't paid any tax on this. This is actually passed on to the investors. That means that actually, in HMRC's eyes, PID dividends from REIT companies are seen as letting income. So on the self-assessment form, this doesn't go as dividend income, this goes as other income. So if you're already invested in UK REITs, the thing to do is to check whether those PID dividends are paid to you after the deduction of withholding tax. All that means is that the REIT company usually will withhold tax of 20% on your dividends and pay that to HMRC on your behalf. So if you're a basic rate taxpayer, that's usually enough. You usually won't have to pay any more tax on those dividends, okay? However, if you are a higher rate taxpayer, you will then need to pay the tax of the difference. So property income will be treated as standard income, so you will pay the standard rate of tax on it. If you get £100, the tax due on that income will be £40 if you're a higher rate taxpayer. However, £20 of that would have already been withheld by the REIT company, so you will only receive £80. It all gets very complex and confusing, and if you're in that situation, you need to talk to HMRC, but it is worth flagging that they do not contribute to your dividend allowance. They are treated as other income. However, sometimes the REIT also pays a non-PID dividend. That is essentially income from activities that they would have paid tax on, and any non-PID element of your dividend is classed as a normal dividend. It goes into your dividend allowance and is taxed at the dividend rate. Now, I've yet to receive any dividends from a REIT, so I'm not sure how this actually works in practice. I'm not sure how easy it is to find out whether they are PID or non-PID dividends. I did contact a couple of REIT companies in the UK and asked them the question. One of them came back to me and said that it would be obvious when they declare their dividend whether it's a PID or non-PID dividend. So it might be just something that you have to check yourself by checking when the dividend is announced, whether or not it's PID or non-PID. It might not be as easy as just knowing in your trading companies, you know, free trade or 212 or whatever it is that you use. Anyway, US stocks. So I actually wasn't aware initially that tax is withheld in the United States at 30%. So generally any dividends that are paid to you will be paid after the deduction of 30% tax. Now, for most of the trading platforms, so I've checked both with Free Trade and with Trading 212, they both get you to fill in a W8 Ben form. So what that means is that you are declaring that you are not a resident of the United States, and therefore you shouldn't pay the 30% tax. What that happens then is the dividends are paid to you net of a lower tax rate, okay? So it goes from 30% to 15%, I believe. Now this is where it gets complicated, okay? So providing you have no other foreign income from other countries, the rest of the dividends that you receive from the United States should count towards your normal dividend allowance. However, should you get any other income from the United States, those dividends are likely to count as foreign income rather than dividend income. So foreign income is taxed at your normal tax rate, okay? It's not taxed at the dividend tax rate. However, again, if your stocks are in an ISA, you don't need to worry about this, okay? I'm saying okay a lot, I'm sorry, I'm like, don't know what's wrong with me today. The one thing that I was not able to get an answer to, and this will be where you will have to individually speak to HMRC based on your own individual circumstances, is if you hold a REIT holding in the United States. Because in theory, REIT income is classed as other income, which basically means that in theory, you're receiving other income from the United States. So that seems to have stumped everyone I've spoken to. It seems to be like a rare thing that no one knows about, which is very, very strange. My personal view on this is that because REITs are generally classed as other income, that it would mean that it's classed as foreign income. That's very confusing. I hope you know what I mean, But the way I'm going to get around this so that I don't feel like I'm doing anything wrong and I don't have to worry about doing anything wrong is I'm actually going to open an ISA, and I'm going to have all my US REIT holdings in my ISA. So I get a lot of questions asking me why I haven't opened an ISA yet. It's probably one of my most commonly asked questions. And the reason I haven't held one up until now is because you get a lot of allowances in terms of like the dividend allowance and everything like that, that for me, I didn't feel like I had enough invested and I wasn't receiving enough of a dividend yet to warrant having an ISA. However, now that I've learned all this about like the US stocks and REITs and things like that, I think it's just simpler to put those in an ISA. That's about it. I really hope that this video was somewhat useful. I tried to make it as simple as I could, but like I said, it's a freaking minefield. So just to be aware, it's not as straightforward, and you do have to generally pay tax on your dividend income unless you're purely receiving dividends within your ISA. On that note, it's my birthday, so I'm going to go and open the lovely bottle of champagne that's behind me, and yeah, I'll speak to you guys soon. Bye.